So where should we start from? There are two major questions where I wanted to start from before we go into the equity conversation. The first question was, we look at next week's auction, pay attention to see how the market has been reacting around it and what to expect. We're going to look at that. The second question is a question which we almost started off last month, about the loans. Let me confirm that we are recording. Okay, because for those who might miss this, they would want to be in position to perfect. So the second question was what we started off last week to do with the loans, where I know Albert brought the second question, where if someone should literally borrow to invest in fixed income. We are going to explore that at a great detail for the first half of the period. Then we shall move on to the equity. We prepare the equity. Yes, Victor, we share the recording for people to listen to it later, for those who might miss some part of the conversation. So let me start with next week's auction. Next week's auction is coming at the time. This week has been an interesting week. So last week, when the governor, Bank of Uganda, had that amazing presentation in the parliament and everyone was talking about the politics of the sovereignty bill, politics so much affects our investments. By Friday and Monday and Tuesday, interest rates were starting to pick up. Now, you'd say, if they are picking up, to what extent? They were picking up to maybe the 15-year bond, which a week prior was trading at around 15.2%, all of a sudden was starting to reach 15.3, 15.4. Then by Monday, Tuesday, when the news came in that, okay, they are changing the bill, they're going to scoop out the financial sector and the banking sector and the direct investments, there was temperatures coming down, and then the rates came back to where they are, 15.2, 15.3. I know there is one good doctor client of mine who on Tuesday they are like, Alex, I'm scared of the auction coming in. I want to deploy some significant amount in the auction, but I'm scared what the rates will be depending on what I know it will be exactly after the swearing in. What rate can you get for me on the primary market? On the secondary market. Then I remember going and searching for different banks, and the best rate I could get on Tuesday was 15.3. They said that's too little because I think we can get that in the primary market. Then the next day a banker gives me 15.5. I take it to him. He's like, I'll take it. Why? He's like, I do not trust that the primary market might beat 15.5 depending on how the rates are going to be. Where am I coming from with that? Next week is going to be pivot. It's going to be a pivoting moment for two reasons. One, if the Bank of Uganda and the Ministry of Finance, the debt office in the Ministry of Finance, want to continue to stamp their presence that they want rates to fall, next week is going to be one of those signature statements. The signature statement before all the political shenanigans of buying parliamentarians, cars and everything whatsoever, before all the shenanigans of voting the speaker and everything. So next week is going to be the statement, because there's been a growing discussion to have interest rates come down below 15%. So next week will be that. And two, the 15-year bond is one of the most sold bond by the government. I think it's over 8 trillion. So they are not so much in appetite to raise so much debt on the 15-year bond tenor. They can easily, because that means the concentration risk becomes extremely high. My anticipation going through next week is, if you have 100 million, now that's a significant amount of money, I would split it into two. half of it I do, if I can lock in a 15.5 interest rate on the secondary market, I would go with that on the secondary market. Then half of the other, I would then take a risk on the primary market. Why? The last time the 15-year bond was auctioned off was in March. At the time, it brought in a 15.75%. But that was the effect of the war. Actually, if it wasn't the war, we had anticipated that the 15-year bond was going to come in at 15% of a 14.8, especially after what had just happened in Feb. So, next week, there might be a little bit of a bloodbath. 2, next week, that bond is about to pay a premium. It's about to pay a coupon, apologies. Which means next week, whether we like it or not, it will be at a premium. If the last time it was sold off in March, it brought in a 3% premium, it can only go higher from here. The question is going to be how much of the premium are you willing to pay? This week, I advised on one of the members here who we ended up choosing to go for the 20-year bond now instead of going for the 15-year bond on the primary market for 2 reasons. One, the 20-year bond is coming back on the primary market in June. But at the time it will come back, it will have less than 28 days to pay a coupon. So it was prudent to invest that money right now. However, the rate he was getting on the secondary market now was much better, and it helped them to avoid the premium. I think we paid a premium of like 2%, and it was a much better decision as compared to if they had just directly went to the primary market. So you have to think 2026. And the good thing of this masterclass, and as we answer some of these questions, this is some of the things you're going to end up learning. Is in 2026, the decision that we have to make in the Treasury bond is changing. You have to think about so many factors. You have to think about so many factors. So as we go through next week, there are 2 my anticipations are these. It's going to be a premium. I expect between 5 to 8%. If it's 8%, it's not worth it. Someone would have bought a 20-year bond, would have been much better. That's why I'm telling people, if you have a significant amount of capital, split it. You go buy a 20-year bond and leave some risk for the 15-year bond. I do not think, and if the government is continuing to stamp, the government, I'm talking about the debt office in the Ministry of Finance and then the Bank of Uganda, if they are continuing to stamp their position of making sure interest rates continue to fall, then we might even say 15.5%, and then that would be dangerous because at 15.5%, we end up paying close to 8-9% premium. A premium that you pay that you end up not recovering it even when they pay a coupon in July. And there is always that dynamics. How much premium should someone pay? How much premium should someone pay? So I know, let me see if I'm having any question there, just so that I don't miss it. But that question is becoming extremely important because if the 15-year bond pays a coupon in July and you end up paying an 8% premium, that means you have just paid withholding tax. You're not going to recover that money. You recover it in Jan. Then the person who has taken the 20-year bond on the primary market, on the secondary market right now, is way much better than the decision you have made there. I'll pause there for some questions. Please bring the questions before we move on to the second topic. I know this is the summary, and I know people are so much familiar with it, but it's important for people to understand what's coming and how they can make a decision out of that. Yes, Anthony. So this is my platform. So thank you. So there are two limiting factors to that question. The first point is when it comes to Treasury bonds interest rates, the information is so hidden in so much information that someone needs to pay attention to so many different figures to understand what's happening, right? Now, on my end, I use the platform that you are looking at, the Refinitiv, to see what's happening. I can, if I get to you, confirm that you can see my screen. Okay. So when you look at it here, right? So you can see it gives me information in time to know what's happening and what is the average rate I need to do. And for so many of you who have helped to secure interest rates, I tell you, give me a second, I know what the interest rate is. Let me go out there and I look for it with the different banks. So here I'm presenting the 20-year bond, which bid and ask. The ask yield is what you're interested in too when you are buying. The bid is what you're interested in when you are selling. Now that interest rate changes every single day, actually every single minute. For you to show to you how the market ends up moving, because this is like, okay, today is Saturday, so you might not see it. If I come here and I change this to 10 minutes, then it will show you how every 10 minutes the interest rates are changing on a particular day. Why? Because every deal that gets settled in the market, someone must update that information in the CSD system. And these guys, the routers or Refinitiv, have the system embedded that they get that data in directly. Now, this is the better way for some of us what we use because we are in the market every day. However, for another person, for a normal person, Bank of Uganda website is your best bet, right? You want to go to the Bank of Uganda website, and now it has changed. It has changed a little bit, so you have to navigate it in a different way. But I'll take you through this in a minute. Where is it? Money market fund, no. No, you don't need that yield curve. Where is the secondary deals that happened? Money market financial reports, daily. Okay, here. So you come here to the daily secondary market deals. For example, okay, they are always a day late, but that's fine. But at least you can get information for what happened a day before. So let's say Thursday, like that. So then this report you can always go into. Now this tells you every deal that has been settled on the day before. And that can start giving you a picture of what interest rates are. Let's go down to, on this day, this was Thursday, on May 7th, a total of 754 billion was traded in the Treasury bond. Then you start looking for the bond you are interested in. The 25-year bond, you can see the last deal of the day was traded at 15.5 yield, right? That means someone bought at 74 million, and you can see they paid a premium of close to 5%. Then the 2042, that's rare, it's hard to find. Then you can see the 2050 bond, 15.5, which means many times that bond traded at around 15.5. So let's look for 2039. 2039, as you can see here, 16.1. Now this 16.1, so what ends up happening when people go to Bank of Uganda and they are interpreting the interest rate, they will see a 16.1 for the 2039 and they're like, oh, someone bought a bond at 16.1. Now, even me, I should get that rate. They forget this report shares the data for both the purchases and sales. So what we do then for us, we shall get that that data, and I be like, let me come and I say Uganda 15-year and I come and I see price history, right? So when I see the price history, then it tells me on the 7th, the trading rate was for buying was 15.3 and for selling was 15.8%. So that means this rate here we are seeing of 16.1 on the 2039 bond, it means that person was selling. But that is actually brings me to the very important point, because like I said, to make money in a treasury bond, you must learn both those two worlds. You must learn the buying and the selling. Now, if the average price, let's go there. Let's go to this favorite Excel of yours that people are now familiar with. So this was on 7th. On 7th May. And this person sold a bond of 30 million. At an interest rate of 16.1. So they got just 31,042, right? The question is, did they get a good value for money? And that's where people forget that you can even lose money in selling. Now, of course, it's a 30 million bond. They sold it for 31 million. So they made 1 million over and above. That's 1. 2. If they bought it prior in 2025, they bought it cheaply, because in 2025, that bond was being sold at a discount. So they've made more money. But the trading data is telling us if bid is when you are selling. On 7th May, the bidding sale was at 15.85%. 15.85%. So if you say, let's assume whoever you are selling it to made some profit off you, and they buy it at 19.5. See, you'd get a little bit more money. So if you sell it at 15.85%, which was the trading data on that day, you end up making almost 500K more. So when you are selling a bond, it's important to know what rate you are selling at. Is also important. I don't know if you have got to the point. So so that 2039 where I seeing a 16.1 from that's buying, that's someone selling a bond. So let's look for another 2039. Let's see. I don't see any other. Okay, we come here. Okay, this is a 2 billion. Oh my goodness, someone moved the 2 billion. So this was most times a purchase, because if you are buying a 2 billion bond, someone can give you that good rate. You can always get it. Hey, they are going to make significant amount of money. Then also this one, 15.85 billion. Most times these are banks selling to each other. They are trading between each other. That's what we call interbank. Sometimes it distorts the market. So then you end up seeing, that's why you're seeing the value is big. You see even here 15.89 billion. So what ends up happening in the market here is the bank, instead of taking a risk, they might be having customers who are trying to come in to buy that exact bond and they don't have it. So they will go buy it from another bank at 15.8 and come and sell it to you at 15.4. That 0.4% difference is where the profits are made. I sometimes tell people, especially when I know a client has a little bit more money, I tell them, if you have a little bit more money, please, please learn how to trade in the treasury bond. Learn to know when to buy and when to sell. You'll be surprised how much money you can make from it. Because I've given you an example. Let's look at this 30 million bond, right? Let's assume you buy it at, you get someone you can buy it from at 15.9. Let me make you a markup. So you buy it at 31.365. That's the money you pay them. Then the next day, you look for someone to sell it to. Remember, the selling is at 15.3, so you sell it at 15.3. In one single day, you have made $1 million. Now repeat it. How many times can you? All of a sudden, you are now creating. The question here is, it's not easy. It's not like this. The market is not so open like maybe real estate or other markets. But someone who is starting to learn these will make money in the future, especially as the market opens up, as more people are starting to learn this. And one of these, for this masterclass, if someone is absolutely want to know how to play this game, I want you to learn the interest rate game. You'll be surprised. I want you, my client Varied, I want you to buy a bond today and you buy it at 15.9. Keep it for 1 or 2 months. You anticipate where the market is going, you sell it. Get that cash in, sit on it for 1 week. Get someone who's buying, who's selling, you buy something much better. Liquidity in this market wins. But most importantly, if you know the game of buy and sell, you will make money. But even if you don't end up trading, because not everyone can easily originate, because sometimes it's about origination, you will make money or save money when you are buying or selling by understanding the interest rate game. I don't know if Anthony have answered your question. Okay. Victor. Oh, the other things, Victor, I'll send you the first video we did in April. Okay. Any question on next week's auction before I move on to the borrowing? I'm assuming silence means no. Apologies, it's early in the morning, so I'm having my breakfast. Okay. So Albert asked a very interesting question. I don't know. Let me bring it in 2 ways. Let me bring it from Albert's position. Then I will answer it in the general perspective, because not everyone is within Albert's position. But I know a few people who are not in Kampala can easily relate. His question was simple. If you have a loan, you can get a loan of 7%. Should you borrow to invest in a treasury bond? Let me tell you, if I get someone to lend me at 7%, I will max out that my loan capacity. 7%. Allahu Akbar. Because at 7%, I'm going to invest at 14% times 2. The bond will pay for its loan. Let's look at the numbers. I prepared for this one because I know this is extremely important. So let's assume, let me use this. Let's assume, because I'm assuming 7%, Albert, is this US? Okay, I'll take the assumption. If you can borrow at 7%, let's say you borrow 10 million. Oh, let me use this for 50 million, significant money. That way we can see the impact. 50 million at 7%. And you get that loan maybe for 5 years, and you're paying that money for 12 every month, right? When you are to borrow to invest when you have to borrow money to invest in a treasury bond, you're addressing three things. You're addressing the liquidity question, that you're going to invest in something that is long term. The question is, do you have the ability to pay for that loan? So for example, people who are salaried, people who have jobs, you are getting a salary loan, they will take money off your salary. That means you have the ability to pay for it. Amazing. Two, you're addressing the interest rate risk, what we call the interest rate hedging, creating a liability for an asset. We're going to look at that, the numbers, that you are creating a liability at 7% to invest in an asset at maybe, let's say, 12, 13% after tax per year. That's interesting, because all of a sudden you're like, there is an arbitrage of 7% that I'm making money on. I'm using other people's money to make money. And this is so good for the people who are not in Uganda, who can invest in Uganda. You can borrow out of Uganda at 5, 6, 7%, bring to Uganda to invest at 14%, 13%. But to look at it is this way. If you get a 50 million loan at 7%, and you have to pay that money every month, and you have the capacity to pay it, that means every single month you have to pay 900K. That's the liquidity question. When you can address the liquidity question, then you are good to go. After 5 years, you would have ended up, for Albert specifically, you'd have ended up paying around 60 million in 5 years. The question then becomes, in 5 years, how much will the 50 million be? Then we come to this other favorite Excel of yours. So you invest 50 million here. Right? Let's assume we invest it at 14% and 10% withholding tax. I'm making the interest rate so low to give it perspective. Then you allow that money to compound. You leave it there for 5 years. You just need to do it for 5 years to match it with the loan you took, right? After 5 years, you'll have at around 85 million. And here I'm using 14% interest rate as the coupon rate. 14%. So that means you'd have made 25 million free of charge. It's not your money. It's other people's money. You borrowed at 7%. If somehow, somewhere you end up buying that bond at 15%, then all of a sudden, you are entering 90 million. 30 million free of charge. That's a 7% loan. So anyone who can borrow below 10%, go and borrow and invest. But let's also look at it as part of and we shall look at this from this angle, because investment is always also about finance. When you understand finance and financial jargons, then you will appreciate some of these things a little bit much better. Let's also look at it from profit and loss, right? Profit and loss. When you borrow money and you are repaying it, if you borrow 50 million, let's now use the Ugandan standard language. Let's use one of the deals I worked on this week. No, it was last week, but one. So we borrowed, how much was it? 250 million at 15.5%. 15.9, it was 15.9. Right? The interesting point about this is what I want you to pay attention to is this. When you borrow at 15.9% and you invest in a bond of 15%, the question becomes, are you making a loss? Right? So let me pay attention. Let me bring it back here. Let me maybe borrow at let's even use 16%. invest in bond of 15%. Are you making a loss? What do you think? Let me hear some opinions on that. What do others think? Phyllis, today you are quiet. Go on. Investment profile, perfect. So he's bringing in compounding. What about others? What do you think? Okay, let's look at it, right? Let's use a 5-year loan. 5, it's okay. Like I said, when you borrow money, there are two elements to it. The money you pay back. There is principal, there is interest. Now, I want people to pay attention to the interest side of it. It's the decision lies there. Because the principal is not your money, you must pay it back. You get the point? The principal, you must pay it back. It's not your money. But interest is the profits they charge off the money they gave you. So that's one. On the treasury bond side, when you invest in a bond, we also are going to pay attention to the interest or the coupon income you make, not the principal. Thank God the principal in the interest in the bond world, you get it at maturity. So that means that simplifies the life. We borrowed, I think it was around 250 million. Let me see. I know he might be here, so he can confirm the amount for me. Yeah. So 250 million. And every single month, he has to pay back 6 million to the bank. Right? But that 6 million he has to pay back, it has two elements. It has the principal of the loan and the interest of the loan. So let's pay attention to the interest of the loan, this column here. Right? The good thing in Kampala, the interests on loans are, we call them reducing balance. Reducing balance is something very important because it means your interest keeps going down as you pay the loan down. So this is month 1. Those are how many months? 60. So this is the interest expense. It's like your cost of doing business in this regard, the borrowing, right? It's the cost of doing business. Then let's get the same 250 million and invest it in a bond that gives us a lower interest rate. I'll use this Excel. So we get the 250 million. We are in July. Okay, it doesn't matter. Yeah, in July. So we get the 250 million. Let's not even use, okay, it's fine to use compounding. Let's use compounding. Let's put it to the interest rate of 13%. Just 13%, right? So all of a sudden, the monthly, if you do compounding, which Anthony talked about, then your money grows faster. But our interest is in the first 50 months, 5 years. Month 1. Because this is something that is a decision that can easily make so many people make serious money if they paid attention to it. So this is your income. I know it, don't get lost here. I know it's getting a little bit technical. Do not allow me not to lose you. So now we have established the interest expense for borrowing 250 million, and we have also established the income if you invest in a bond at 13% interest. Then the question becomes, at what point do you break even? For the business people do understand this language. There. So all of a sudden, because the interest rates in the treasury, in the loans is a reducing balance, it means interest rates keeps coming down. If you compound your loan, your bond, interest rates keep going up. What that it does, it means at one point, after 18 months, you will break even. So look at it as a business. You go get 100 million and invest in a business. But for the first 3 years, you are still, whatever income you are making is literally covering just the costs of paying rent. You have not yet made a profit from that investment you made from your capital. Then after 3 years, you make a profit. So in treasury bonds, boom, you break even. If you compound, you break even. Which month is that? Where do you break even? We can look at it at the numbers. See? If you do compound, you break even as soon as like the year 2. So to give you a direct answer, if someone can borrow money at less than 16% reducing balance, and you have the ability to pay for that loan, you borrow and go invest in a treasury bond. The numbers tell you in 1.5 years, you'll be making a profit. But that looks at the profit and loss side of the bank, the balance. It doesn't look at the, what's the word? The balance sheet. It doesn't look at the cash flows. Now that's the jargon, which I don't know if we should enter into. But you understand the dynamics I'm introducing in. Maybe let me pause here for some questions, because this is important, and this is the whole instance of some of these discussions where we go deep into something that makes you to think and make a right decision that later you be like, wow, I didn't know that I can actually do this, and it makes your investment decision much better. So bring the question on. Yes, break even. Yeah. Break even means your expenses. Remember, your expense is what the interest rate you are paying on the loan, right? So we understand that. The income is the income you are making on the treasury bond, your asset. So you have two things here. You have the income from the bond. You have the expense from the loan. So the point where they equal each other, they meet, that you are at I was going to say at an equilibrium. And I'm like, okay, I don't want to go into that level. But at the point where they literally, the money you are making from the treasury bond is equal to the money you are making, the money you are paying on interest, where they become equal, that's the break-even point. In business, it's extremely important. I know our type of doing business in Kampala, we don't track some of these. But in business, that's the point where the revenue, the income you are making from your business is just enough to pay off your expenses. Mm. That's a very good question. Now, let me put it differently. Let's call this option 1, where you compound, right? Now, send this. So let's go to option 2. No compounding, right? You usually withdraw that money and you pay the loan, right? In option 2, this income is not correct. Because in option 2, the income should be straightforward. So how do we get that? Let's come to this Excel here. How much did we consider? We considered 250. Let's use the 20-year bond that has a lower interest rate. I can actually compute it here. I don't need to go there. So 250 million, right? If you buy a 20-year bond, it has a 15% coupon rate. Withholding tax is 10%. So that means every single year you'll be making that, and the net return is 37 times 90%. 33 million. So 33 million, divide this by 12. Let me hope you are following me. So then let me come, that means that's the money you are making every single month. 2.8. Right? You can see, even when you are making a fixed return, you will still break even. You will still make, the question, and I know this is where it starts to become a little bit confusing. The question becomes is, how do you, even when I do not compound, I still make money? It's because the interest rate regime in Kampala, it's reducing balance. The interest rates you are paying keeps going down every single month. So you are in a loss in the first 14, 15 months. After that, your interest rate, the interest you are paying is down, but the income you are making on the treasury bond is fixed. So if we are to draw this on a graph, so the first graph, our first chart, you see the yellow curve, the income from your treasury bond is increasing because you are compounding. It starts to become exponential. You break even fast, but then the gap widens as time passes on. That's the best option. The second option, the income is straightforward because whatever income you're making, you're withdrawing it and you're using it to pay the bond or using it for whatever that you're not compounding. So your income is straightforward. The rate that of the interest rate is coming down. And then at one point you break even, and then it keeps going down and down and down. Does that answer your question? Any other question? The two what? Oh, okay. The totals. Okay. The before compounding and after compounding, right? So this is before compounding. You can see the interest rate you have paid is 113. The interest income you have made is 168. Then with compounding, it means the same. This goes to 210. You have used someone else's money to make money. Or if, as long as your liquidity is safe, the day people will discover this and find banks that can give them interest rates of 16. People. Okay. So compounding is, let me show you something. This is the only Excel I do not share. Where is it? Because I use it to track my things. This one, you can see it has even Kakanda Alex's name on it. But I'm going to go through it in the most simplest, basic way possible to understand the direction, right, of compounding. Let's assume, let me take that out. I don't need that. Let me use here and start here with what? 100 million. 100 million is always good to use. So let's assume I have 100 million worth that I want to use to buy a treasury bond, right? Oh, I bought a treasury bond. Let's use the 15-year bond here. I don't know why it had that. Simply speaking, a 15-year bond, I know it pays me in Jan and July, right? We know that. Okay. You have to understand when the bond pays to track your actual compounding. I have a simplified compounding, but hey, you deserve the best. So let's go through this because it gives you a better picture of what compounding is. So a 15-year bond pays in July and Jan. In Jan and July, you know cash is coming in. So if today I go in and I buy a 100 million bond, I know every Jan and July 700K is 70 million on average will come in after tax. Because a 15-year bond, it has a coupon rate of 15.8%. So after tax, it becomes 14.2%, which is around 7 million. It will come in after tax. That's why you see in July, I have a 7 million coming in. Let's use up to, yeah, that's where I stopped. I always do compounding up to 7 years and I recalibrate the assumptions. So my assumption I've already captured to say in July, when the 7 million comes in, it is coming in on July 9th. I know. I've already planned in a different color. I must be buying another bond of 700K of the 15-year bond or a 20-year bond. Why? Because I know those two bonds, they pay on the same day. Now, I want you to follow with me. Let me repeat this. That I know in July, on July 9th, I'm having 7 million coming in as a coupon from the 100 million. Right? That 100 million, that 7 million, I will buy a second bond, either 20-year bond or a 15-year bond, or any other bond for as long as it pays me on a particular day that I want it to pay me. But let's go with either 20-year bond or 15-year bond. On the secondary market, I'm okay. So now, by July 2026, I will have two bonds. I will have the first bond of 100 million and the second bond of 7 million. Then in January 2027, how much money am I going to get? I'm going to get the 7 million. The original bond 1, I'm going to get a 490K. The bond 2. Now I'm going to get 7.49 million in Jan. Watch Chenga. But I know, again in July 2027, I will be paid. No, on January 2027, when I'm paid the 7.479, I know I've already planned it. I will invest it in another bond that pays me on a day that I want it to be paid. Now that's when you're taking the decision making to a next level. At that point, you're no longer playing in the game for the sake of it. At this point, you are intentional when you should be paid, because now it matters. This is your money. This is it. So in Jan, I get the 7 million and the 490, which is that's 500, and I'm paid 7.49. Now I invest and a third bond. Now I have bond 1, bond 2, bond 3. Then come July 2027, the original bond will pay me my 7 million. The bond 2 will pay me my 490. Bond 3 will pay me 524. Then by July, I have 8 million. A year ago, in July 2026, I'm going to get 7 million. A year later, I've got 8 million. But I also have 3 bonds. Now, all they have been birthed from the original bond. So I also invested this 8 million. I buy another bond, bond 4. Then in January 2028, I will still get my 7 million. Bond 2 will give me my 490. Bond 3 will give me my 520. Bond 4 will give me my 564. 4 bonds, all bringing in money. Now I have 8.5, 8.6. I also get that. An assumption is I'm doing the hard compounding. That's why I said this Excel, I designed it for me to do the hard compounding. Like you are literally, I'll give you even the synopsis of it. Right? The account I'm tracking this in, that bank account, I don't even have its ATM. It's not connected on mobile money. It's the money that goes to that account is purely investment. It's purely hard accounting. What does it mean? Like, you know you're not going to withdraw this money for at least 5 good years. It's discipline, it's tenacity, it's the level of effort it's going to take you to say you are seeing it growing. By 2028, by July, the 7 million will come. Then the 400 will come, another. Now I'm in 9 million. After 5 years, let's count how 2, 4, 6, 8, 10. Yeah, January 2031, that's the 10 year. After 5 years, I'm making it 12 million. Every payment. Now take a step back and think about it and be like, you know what? What is the possibility if I start it that way? What's the possibility? Because now that's what we are playing in. So you know that this is the hard compounding. It's hard what way? I've not added in any single money. I've just literally used the original amount and I've tracked it when it comes, what bond I must buy. And you can see income is growing every single day because now I'm creating different bonds. In 5 years, I have like 10 bonds. Each bond is almost giving me some money. Where have I got the money? The original mother bond. Whatever it gives me, I put it somewhere. Whatever it gives me some. It's feeding. Hope you had a question. No. Okay, thank you so much. Compounding, I'll give it to you so much for me, right? Compounding is about where you make the money. You can put it in the exact same bond, or you can put it in another bond. The one I'm showing you here is where I'm literally tracking specific types of bonds. Now, like I said, this Excel is a little bit tricky because I have access to the market, so I know what bonds I'm tracking into this. So for me, I'm putting it in the exact bond. Why? Because I want the payment to always come on the same exact payment. So that way, the value of that one bond keeps growing. But it doesn't stop you from putting it to another bond. Your goal should be to say, the simpler compounding what is this one, right? That every year you know you want to get, let's say, 15%. It doesn't matter. So you start with 100 million. And every single year you put the money in, money in, money in. Whenever they pay you the money, you get that money, you put it in another bond. Whether it's the exact bond or another bond, it will still compound. The limitation to that when it's not intentional is sometimes you end up buying a bond that lowers your interest rate. So you need to know maybe I should say it this way, Hope, that you need to get to a position where you say, what interest rate should my compounding be at? What is the minimum rate below which I will always look for the best? So I always give people, like you say, you want to set it between 13.5 to 14%. That's achievable. It's achievable. Then whether you buy that exact mother bond or you spread it to other bonds, that's fine. Either way, that will compound. Either way, it means what you end up seeing here, the Jan, July, might change. It might become Jan, July, August, September, because the payments are going to be scattered everywhere. The only challenge with that is you want majority of the payments to come in a concentrated manner, in a concentrated month. That way you don't need to wait. You don't want it to be paid 490k in Feb. Now you have to wait for another 400 in March, April for it to total up and you invest. But if it's concentrated in the singular month, Jan, Feb, those months are very good. You always reinvest the money faster. That means every month that comes in, it's making money. Every month that comes in, making money. And the first 5 years, what looks linear after 5 years, when it starts to take on that exponential graph, ash. I hope I've answered the question, Hope. Yeah. Someone has asked, is it good idea to put the coupon on the unit trust? Now we are going into the details of compounding. Yes, it is. It's a good idea. Is it the best idea? Let's take a step back. I know some of these master classes, they build onto what we talked out previously. Do you remember the ceiling and the floor last month? You must remember that, right? For the unit trust. So if your unit trust has already hit, yes, it's a ceiling, then why would you put the money there? Because it's 11%, it's 12%. You can compound at 14% and above in the Treasury bond. However, if your ceiling has not yet reached there, then take it to the unit trust. 2, which is also most important, is this. Let's assume, like Hope talked about, you end up reinvesting. The bond 2 is not in the mother bond, so you're going to get paid in, let's say, Feb, but you're going to be paid 490k. Then the bond 3 is going to pay you in May, which is going to be like 500k. So you cannot necessarily, you might not feel comfortable to invest 490k on its own. And yet the mother 7 million is going to come in July. So what do? You get these 2, take it to them to unit trust, as holding, let it make a small money there, as they wait for their sibling. When the sibling comes in July 7 million, you also get the other small one, put them in one thing and ship them to another big bond. You need both these worlds. So if you've already covered the ceiling and the floor we talked about last month, which I think by now everyone has already established that, then when you send the money to this unit trust, it's either you are covering the ceiling or the floor, or you're taking it there temporarily as you wait for a bigger payout and then ship it to something bigger. Or there are times, I'll tell you, even I personally, and I use myself because I want to believe I'm a little bit advanced in the market compared to a normal investor. That the times I will look at the interest rate that are on a particular month, and they do not make sense for me to invest there and then. What do? I send the money to unit trust and I'm saying, let me wait for next month. And I wait for next month, maybe the rates might be better. There are people who are sitting out right now in next auction. There are people who I've talked to, some of my clients, who are sitting it out. Because I've already told them the 15-year bond is coming at a premium whether you want it or not. They're like, Alex, let my money remain in a unit trust. I'll invest in June when the 20-year bond comes back. The challenge with the 20-year bond is going to come back when it's about to pay a coupon, when it's pregnant. And you remember last month, we said pregnant bonds are the most expensive bonds. It will be almost 1 month to give birth. So I'm like, you are sitting it out. You might want to sit it out until August. And hopefully by August, the parliament would have done its shenanigans and interest rates are back to in favorable condition. But if they find a way to control everything and do not do damage, by August, sometimes even rates might continue going down if the oil money comes out also. So there are so much dynamics, and over the course of the year, because the good you see, we always benchmark on the economy as it evolves. As you see it, you will start, that makes sense to this. Then you start pinpointing some of these conversation. Yes, Atima. Mm-hmm. Mm. No. At least I don't. Okay. The only limitation I know is one. You cannot buy more than 200 million in go on one single CSD. You enter into the competitive bidding. But beyond that, there is not a single one. Zero. From an advisory perspective, the only thing I might add for you is you want to, let me put it differently. Okay, let me start it from this angle. I know we shall talk about it maybe in the 6th or 7th month. Risk. When investments and decision making is literally, actually most decisions in life are about risks. You want to assess and come up with your risk register or parameters and say, this is how I'm addressing them. I will never advise someone to have more, in an individual capacity, to have more than $1 billion of treasury bond on one CSD. No. Go open up a second one, a third, a fourth, a fifth. Now that might be my higher ceiling, but maybe your ceiling might be 300. For as long as I reach 300 million, thank you so much, banker A, off to banker B, and I build it in that way. Why? Now, it's not to say that you are money laundering or whatsoever. No, it's to say there are certain limitations, there are certain headaches used by spreading yourself to different banks. One, if you have close to $1 billion, or let's say 500 million, depending on your parameter, that means every time they pay you a coupon, they're going to pay you a coupon of how much? 60 million plus, a lot of money. That someone might even charge you so much withholding tax without you noticing, because they have paid you so much money. So spread it in the different accounts. At you reduce the risk on the entity, you also reduce the entity, the risk on a human error that comes with, because these are organizational. These are organizational. But there is no single limit that I know of whatever. I know I have clients I serve who I know have billions and billions right now in bonds. Sometimes you go, someone comes and like, Alex, I'm buying a 5 billion bond. What rate do you give me? You're like, hey, you go looking for it, and every banker is almost trying to ask you for your intestines because you are like, why do you have the client of 5 billion? That should be our client. So no, I don't know any risk. But we shall talk about the risks and how I look about it and how you end up making certain decisions a little bit later in our journey. Any other questions on the compounding, on the loans, and next week before we move on to what would have been our topic, though it seems it will go into next month. Okay. I think we have covered that. That was extensive, but we shall keep coming back on, and as long as questions keep coming back in that regard. Now, one of our key discussion points this month was supposed to be, yes, Rachel. Oh, I've seen the question. No. A competitive bidder is someone who in a single auction on one single CSD applies for a bond of more than 200 million. Like, you become competitive, you are allowed to set your price. The only problem is that price might be rejected. But having bonds of $1 billion plus, no, you're not. It's your portfolio. You can have $1 million. You do remember my CSD I showed you last month, right? You can have so many bonds and they will grow. I assure you one thing. By the time if you play in this market for the next 5 years, by 2030, you will look at your statement, it will have over 30 plus bond. It will, okay, maybe over 10 plus bonds. The 20-year bond and the 15-year bond, they are more likely they are going to get discontinued. The 10-year bond is most likely it's not coming back. So next financial year, starting in July, we are getting a new 10-year bond. What that means, if you buy that, it becomes part of your portfolio. If you have some of us have a 2033-year bond, 2034, 2035. We might get a 2036 soon, potentially. Then if they discontinue the 2039, they might introduce a new 2040 bond, or they might bring back the 2040 bond of 17.75. The problem is that bond has a higher coupon rate. I don't think they want to bring it back. So they will introduce a new one in July or August. Now that will be a good win for us. The 2043 might get discontinued. Then they bring in a 2044 bond, or 2045 bond. Now you'll have another bond. All of a sudden, every single year, you are, as long as you are buying or compounding, it will start to grow. Right? Then someone asks, I just want to be sure, is it possible to not withdraw coupon when it matures and just leave it? Yes. We have talked about that. You can not withdraw and buy more and more bonds on the market. That's the compounding element we talked about. No? Oh, then give it to me what you mean. Yeah. Mm. Yeah, it was really good. Absolutely not. So one of the risks. Actually, let me talk about this. I know it might not cover what as I had planned, but it's actually very, very. Thank you so much for this question. One of the risks we barely talk about, it's sometimes because we don't want to confuse also the market. It's what we call the reinvestment risk. It's extremely important in the treasury bond or fixed income products. The reinvestment risk is the understanding that, okay, I'm buying my initial bond at, let's say, last year, 17%. But one day they're going to wake up in August and they pay me a coupon when interest rates are 14. So what do you want me to do with the 14 when one day, when I tested the 17%? And it's designed that way because rates change. Bank of Uganda, or not even Bank of Uganda, globally, the interest rates will change. The yield will always come down or go up. The money comes to your bank account, which means the coupon income, it comes to your account. It means it's no longer an investment as a bond. It's cash. The decision is yours to make and purchase a second bond. So what that means is every time they pay a coupon, it's incumbent upon you to sit back and be like, I need to make a decision. Which bond should I buy again that will make me a better money? Now, last year, if I'm to use the comparative you have used, last year was an amazing year. Everyone made money. Even people who they sold off at 16.5, they were happy. Like this year, all of a sudden, that is gone. This year is where you literally, every time you are buying, you have to inquire, where do I, you have to now to think, you have to get an advisor, like, this rate I'm getting, does it add for me? It's a little bit harder this year to make money. But the best way to look at it is this way. Maybe you bring the same concept. The only concept here is about the flow, like we talked about last month. The ability to say, I will never buy a bond below this rate. It doesn't fit into, you create a conservative rate and say, anything above, I'm happy. But anything below 13, I'm never buying. That way, you cannot, if at any one point interest rates have fallen below, you're like, let me look for an alternative way to put, where to put my money. Or if in a particular month the rates are down, you're like, let me put them in a unit trust and I wait for another. That's the way you can manage reinvestment risk. But because it's a risk, risks have both the downside and the upside. In 2025-6, interest rates are down. So that means as we are buying this year, we are buying at low. But we don't know what might happen in 2028, that all of a sudden interest rates will pick up. Now you might even make more money in 2028. Let's look for Kenya, for example. It's a perfect example to use. 2021, 2022, Uhuru's case, interest rates were below, were in long-term bonds were at 11%, 10%, maximum 12% in the 25-year bonds and above. Then an unexpected happens. Ruto wins the election, only for him to find, as alleged, the coffers are empty. At the time, the Eurobond is coming, the maturity of the Eurobonds were coming. There was so much pressure on the economy, on the finances of the economy. But too, a new president has come in, and he has come in with his new people, who they also must first get fat. you know, and that's some of the politics. And the pressures between 2023 to 2024 in the Kenya economy. All of a sudden, interest rates shoot from the 12% to 18%, 18.5%. One time, even an infrastructure bond that is tax exempt was issued at 18.5%. But thankfully, they managed. And then by end of 2024, coming 2025, interest rates started coming down. They came down in 2025. Many of my Kenyan clients started investing in the Ugandan economy because while their interest rates were back to 12, 11, in Uganda, we had entered 17. And that's how somehow it works. Now, right now, next year they have an election. We are starting to see a slowly but standard uptick in the Kenyan interest rates in the Treasury Bonds, while ours are going down. Now we are starting to strategize and saying, should we start putting some money aside for the Kenyan economy next year when they are in the election period? So that cyclic nature is part of your reinvestment risk. Actually, for someone who has, when you start thinking about this in the very nature, and like I said, I have a unique clientele in this masterclass. Some of you have the capacity. You'll be like, you know what? Time to get serious. Let me find a way to open a bank account in Kenya. Either way, I'm investing in this for the next 20 years. Once in a while, every time I see Kenya making better returns, I move to Kenya. I put some money in Kenya. My bond in Uganda pays, I send it to Kenya because that's where it's making money. Kenya goes down, I move it to Uganda. We move in. When ours is down, the Kenya is up. When Kenya is up, ours most times is down because most times these are political, cyclic nature. But in treasury bonds, that reinvestment risk is present, is important to manage. What I always guide my client is set a floor, set a minimum return, a conservative return below which. And when you are doing even your projections, you can easily say, my projections are at 14%, 13%. You will compound and you will make money. Below which, you're like, if I get a rate of 13% below it, I'm not buying that bond. Stay with your bond or stay with your investment. That's understanding the return on investment concept. I hope I've answered your question. Okay. So we have less than 10 minutes. Should we start on the equities or should we leave it for next week? I'm open for consensus. I try to avoid introducing a full topic when in the bombardment of so much information and it ends up becoming not the right way to do it. Liz is saying, let's push. Okay. Let me put it this way. We have how many? We still have 10 plus months to go. The equities is important. I don't want to introduce it at a time when today has been also so much, every session has so much loading of information, right? Let's call it a day to day. We have so much questions people have. Let's take them to the WhatsApp group and we clear those. I know there is always those fallback questions. Plan through it. Look through your portfolio. If you need a one-on-one to strategize and see if you can get a loan on your portfolio, which I talked about, it's very important. There is money, there is other people's money to make from there. Let's engage from that side. All right. Yes, please. Yes, majority of them I think there are only two that I do not share. The rest I can share. I will share them actually into the group and such that people can use them. And I will upload the video on YouTube for people to look at, to replay it. But let's bring the questions to the green app. All right. Thanks so much. Have a good evening.